the screen here. Welcome to the Iron Condor Part 4 discussion this afternoon. What we're going to do today is review a little bit of Part 1, Part 2, and Part 3 that are already in the previously archived sections of the webinars. You can access those. We'll give you a link to that later on. And then Part 4, Mike Phillips is going to walk us through some discussion on restrictive contingent orders, discussion on the flash crash of May 6th, and some methodologies to enhance the protection, to enhance the closing procedures of the Iron Condor's positions in those type of drastic, unknown, and uncertain events. I just want to remind everyone, of course, for those of you that may be on your 14-day free trial to PowerOptions, if you subscribe to PowerOptions before the end of your 14-day free trial, you will receive an additional 14 days free. And for those of you who have not been involved with PowerOptions Applied, the advisory newsletter service, we'll give you some information later on in the presentation on registering for your a subscription account possibly to the PowerOptions Applied services, depending what matches your personal risk and reward tolerance. Well, to begin briefly, let's just review what is PowerOptions. Now, PowerOptions is a patented suite of search and analysis tools that was developed by Ernie Zarenner over 12 years ago. Part 3 of our Iron Condor discussion, which is available in the webinar archives, was designated specifically to using the PowerOptions search, analysis, and research tools and the portfolio tools to help you identify Iron Condor positions, track them in the portfolio, and view potential rollout opportunities. And the PowerOptions tools are designed for self-directed options investors. Those patented tools allow you to search across the universe of options in less than a second to identify only those positions in a given strategy that match your personal risk-reward tolerance. We do support over 23 different common option strategies on PowerOptions. We also, of course, have those powerful set of portfolio tools to help you paper trade, track, and manage your positions, whether they be Iron Condors, standard vertical spreads, the bear call, or the bull puts. And, of course, you can view analysis on adjusting the positions after you've been in the position and the stock has moved, or see opportunities and have the calculations done for you of potentially turning a bear call credit spread into an Iron Condor or bull put credit spread into an Iron Condor based on the movement of the stock itself or the underlying security. We also offer countless educational articles and help pages for the different strategies and the tools on the site, as well as a listing of a variety of archived presentations, both strategy discussions and how to use the PowerOptions tools. Now, as I mentioned, we've been in business for over 12 years. I should update that slide. But we have many more years of combined trading experience with the staff, and everyone here at PowerOptions uses these tools to trade their own personal accounts, and the only time we here at PowerOptions use our brokerage accounts, whether it be Options Express, Fidelity, or Trade Monsters, when we're actually entering a trade or placing a trade. All right. My name is Michael Chupka. I am the Director of Education here at PowerOptions. I handle most of the coaching sessions and a lot of the live webinars. I've co-authored 2 books on option strategies, one on naked puts, one on protective option strategies using married puts and collars in different markets. I am versed in all strategies on the site, but there are certain strategies that I do not trade in my personal account, things such as naked calls, short straddles, short strangles, and iron butterflies don't really match my personal risk-reward tolerance, so I don't trade them in my personal account. But if those are strategies that you use, I can help you with that. But what we're really here to talk about today, of course, is the Iron Condor strategy and the Iron Condor techniques that are used at PowerOptions Applied. And for that, we're going to turn things over now to Mike Phillips. And Mike, why don't you tell us a little bit about yourself and what we're going to review today?
Good morning. Welcome, everybody. This is the 4th in our series of Iron Condor presentations. I really thank everybody for coming out to join us. You know, what we're going to discuss today is not really what when we originally planned to do the webinar, and we had a whole different topic we were going to discuss, but since we had the flash crash occur on May 6th, we're going to kind of cover that today. But my background is engineering. I designed chips for a number of years and then got into investing with the options and started to work here at PowerOptions. Really liked the Iron Condor, but it does have its idiosyncrasies, which we'll discuss a little bit in just a moment. So do I have control of this?
Yeah, I was just going to turn that over to you, and while I'm doing that, I just wanted to mention to everyone that one of the main reasons why we're doing this series is the release of the recent book, the Iron Condors Neutral Strategy for Uncommon Profit, that was written by Mike Phillips and Ernie Zerenner, and all of Mike's experiences, thoughts, and what he does for the Iron Condor presentations are listed there in that book, and we're going to talk a little bit about that. And Mike, why don't you just go into that attendee list there, and why don't you go ahead and just take over control of the presentation.
Okay.
There you go. All right.
PowerOptions Applied is a newsletter, and we trade a number of strategies: Iron Condor, covered call, collars, double diagonal. We're going to add a new thing for our customers, which is we're going to call it the safety net. And basically this will be long puts for index options. This way, when we have some market volatility like we've had in the last couple of weeks, we'll smooth out the ride a little bit. So we'll be sending some more information out about that pretty soon. We do auto trade with some select brokers. Mostly we auto trade with Options Express because they support some of the contingent orders that we really like to use with the Iron Condors. We have BrokerLink, which you can do one-click trade entry. Some of these trades have a lot of legs, kind of a pain to enter, and so BrokerLink kind of cuts that down. It's nice. BrokerLink's nice because then we can post a trade and you can see the trade, and if you like it, you can trade it. If you don't have to trade it. And there's a picture of the book and the testimonial. In our agenda today, well, I got ahead of myself, but we did have 3 other webinars which you can view on the PowerOptions website at powerop.com/webinars.asp. Those are also on the PowerOptions Supply website. You can look for the site map, see where those are located. And now is our agenda. We'll do a brief review of part 1, 2, 3. We'll just kind of blow through that, and then we'll talk about the flash crash and the contingent orders and what we're going to do on that. Well, why trade an Iron Condor? Well, it's leveraged, and you don't own any stock. It's just all options. Say limited monetary risk. If we're careful, but in this flash crash we had some really nastiness happen. So we'll talk about that some more. You can get special margin, which really allows you to juice your returns. Most of the time the market's kind of neutral. We haven't seen that lately, but most of the time it's kind of neutral, and it kind of hovers around in one place, and then like we've seen in the last couple of weeks, it'll make a big move. And this is a nice complement to other strategies, and we harp on this over and over. It's not something you want to put a large bulk of your investment or your portfolio in. It's just a limited amount. Because you could lose a lot of money, and so if you had 10% invested, then you lose, in Iron Condors, and use 50%, then your portfolio is down 5%. And you can recover. But if you put a big chunk in your Iron Condors and you have a big loss, then it's very difficult to recover from that. There are some tax advantages that you can take advantage of. You can see there's an article on the PowerOptions Supply website at powerOptionSupply.com/tax-advantage.asp. You can read more about that. Iron Condor is a combination of 2 other popular strategies: the bull put credit spread, the bear call credit spread. Put those together, we have the Iron Condor. This would be an example of a bull put where we have a short option at 395, a strike of 395, and a long put option is with a strike of 385. This would be an example of a bear call spread where we would have the short call option at 500, and we would have the long call option at 510. Put that together, and you can see it looks just like a combination of the 2. There's kind of two cases for Iron Condor. You can do non-special margin and special margin. For special margin, the brokers, since there's only one way you can lose it, either lose on the bear call or the bull put, they will allow you to use a single leg, margin for a single leg, if there's some special cases meant. And those special cases are that all the options have to be in the same month of expiration, and that the difference between the spreads for the bull put and the bear call have to be identical. And what that allows us to do is, say in a special margin case, say non-special, we had the margin requirement of 19,700. For special margin, we might have a margin requirement of 9,700, so we have half as much margin.
Right.
And what that allows us to do,
I was just going to say, let's break that down a little bit. The non-special margin, you would have had to have the money on hold in your account on both sides of the spread, both 10 points with the 500 and the 510, and on the put side. But with the special margin, you only have to cover one side or the other, so you can reduce the amount of money, that you have to have on hold in your account and increase your returns. I'm sorry, Mike, go ahead. Sure.
And as Mike said, increase return. Basically, we double the return by doing that. There's, as far as trading Iron Condors, we really recommend trading, ETFs or indexes. We really frown on trading stocks. Stocks are so volatile they can make a huge move. Even though the market can make a big move, overnight, stocks are even more likely to make big moves. So, and the reason we really favor indexes for Iron Condors, and the reason is because we have lower brokerage fees because the prices of the index are usually up in the 1,000 range. There's also the tax advantage if you're trading broad-based indexes, and then also there's very high option liquidity. So there's a lot of people in the market for the indexes, so you don't have to worry about not having a really huge wide bid-ask spread because nobody's trading it. Mm-hmm. Generally, the Iron Condors that we trade are smooth sailing, kind of boring, but occasionally they get very exciting and can be very risky. So what we kind of say is, we're going to stay away from the edges as much as possible. And even that, as we've seen in the last couple of weeks, can cause a lot of problems. Even if you do stay away from the edges, you can still get some problems. By the edges, we're talking about the short options, the short put and the short call. And basically on May 6th, we kind of went over that. We went over the edge of that waterfall that I just showed you. This is an example of a trade that we had for the SPX. This is showing the put, showing the stop loss we had for the put, which was at 1132. And we had a short put at 1110, and the long put was at 1100. And we hit the stop at 1130 at the value of 1132, and it looks like it's about around 1130. And so we had contingent orders, which closed the short option for people that had adequate capital in their reserve capital in their account. They were exited out of that. And then shortly after that, not too many minutes, we sent out an order to close because there was a large value in the long put option. We went ahead and sent the order out to close the long put, and then we also sent out the order to close everyone that didn't have sufficient capital to get out of the position. And then we also had a position for OEX, an Iron Condor. And now that one, just because I guess it's kind of serendipity or unserendipity, look at it. We had the stop loss at 510. We hit that stop loss much later than the other one. If you look at it, it was about maybe 240. And you can see that the market, where the index took a significant drop and then bounced right back up. And so we did send out, the order to, just like we did in the other case, to close the long put, but by the time the order was entered, the market had already recovered, and so we had some problems with that. The last time we saw something like this that I recall was back in 1987 when the market kind of tanked like that, and that shows you kind of what the graph looked like. You can see where it spiked down significantly. The Dow went all the way down to almost the 1600. It was just in a few minutes, just kind of like what we saw the other day. For the two trades that I just showed you, for accounts that had sufficient funds that they could close the short put with their contingent order, it worked out like we planned, our strategy, and that we ended up with about a 5% gain by you executing that method. But the OEX position ended up with a minus 47% loss just because the market rebounded.
Now, when this was triggered, you were able to close the short put in this case, but did you also manage to close the long put at the same time on SPX when it got the 5% gain, or were you just able to close mostly the short put in that case?
For this case, we closed the shorts, and then we sent out an order to close the long a little later. And in the case of the SPX, the market dropped, and because of that, the long put had gained value. And it had gained enough value.
Oops. I apologize. I think I think your sound cut out for a second there, Mike.
Okay.
Oh, okay. You're back. You're back now.
I'm going to get closer to the microphone. That's the problem. But it was really just a matter of timing. If we go back a little bit, you can see we hit the stop loss much earlier, and we had time to send out an order. Whereas in the case of the OEX, it was just a couple of minutes between when we hit the stop loss and when the market went down and then back up. But for accounts that didn't have sufficient funds, they were closed with the follow-on order. The SPX had a minus 39% loss, and then the UX had a 61% loss. This is an example of. This is not the example that happened the other day. This is just to show how we normally set the stop losses at like 1%, where the short put would be at 395. So we would set a contingent order stop loss at 399 to close the short put. There goes my cell phone. Sorry about that. And then for the short call, we'd also have contingent order at 495, about 1% away from the short strike of the call. And this is kind of how our old method of doing stop loss. We had a number of choices, and that was we would close the pending short option, and if there wasn't much value in the long option, we'd just leave it open, and then that way you can't you can use it as a hedge, because you might have 3 other positions, and so if they start to hit their stop losses, then this long option can help make up for the losses.
Yeah, if the market still keeps going against you, if the market had dropped, we closed the short put, which had increased in price and was our obligation to buy shares of stock, and it might result in a loss in the position. But if we leave the long option open, the long put, and the market continues to move down, then that long option is going to counter some of the loss that we might have taken. So this can work in certain situations, but it didn't really in this scenario, in the May 6th scenario.
Right, exactly. Well, it worked in one case, but then all the other ones it didn't work. So, then the other choice is to close both the defending short and long options. So on May 6th, that would have been to close the short and long right immediately. And then the other choice is to close the short option and then close, partially close the long. And the choice on that is, if there's a lot of value in the long, we just immediately go ahead and close it, because you can get the rubber band effect if the market bounces back. If there's some moderate amount of value in it, then you might close half the long option. And then that way you can still use it kind of as a hedge, but you some of your money off the table. And then the other thing is really just to close everything. You close the position that should be positive or have a positive gain on it, and then you also close the offending or the leg that's probably having a loss. A few problems with this old strategy is that when you get a market meltdown, kind of like on May 6th, it's the option volatility jumps up. If you look at the VIX, it jumped way up, and so the options jumped way up too, the value of the options. So it was difficult to have enough reserve capital, in order to execute the contingent order. And then the other thing is that really in order to get out of the position, you almost have to close the positive position.
Okay, so in a situation where we had the Iron Condor open and I might have been trading with 10 or 20% of my account in an Iron Condor position, when that drop hit, I may have looked to close the short put based on the contingent order that we had placed or the market order that was there. But what I might have had to do is actually close the bear call side, the side that was not threatened at all, that had actually reduced in so much price and was very cheap, in order to free up some margin, in order to have the money available to close the short put that was increased in price due to volatility and the sudden drop.
Right. Well, that's how we normally get out of a position that you can't close that you can't close if there's not enough capital to close the offending position.
Mm-hmm.
We'll close the position that's profitable, and then close the position that's having difficulties. And then if you have a quick market rebound, as we saw with the OX, then you end up with even a bigger loss than if you'd have just exited with a spread order. And we'll talk about that in just a minute. So our change in strategy now is really, there's kind of three things. One is to execute a four-legged contingent order, and as far as I know, at least Options Express doesn't support that right now, and maybe some other brokers. But if a broker has a four-leg contingent order, then that's the way to go. Another one is another spread contingent order, and again, that one's not supported by Options Express. If your broker supports that, then that would be a way to go. And in this case, what you would do is you would set up an order to close the non-offending or the profitable spread, which would then trigger an order to close the offending spread. And then another one is, which is kind of what we're going to talk about most today, is 4 contingent spread orders. It's kind of complicated, but this way everybody can get out and don't have to worry about market rebounding, this rubber band effect. Let's see, I already talked about the other trigger. Okay, we'll go on. And for the 4 contingent spread orders, there'll be 2 contingent orders to close the non-offending spreads. That's the ones that are profitable. And then 2 contingent orders to close offending spreads. And this shows the profit and loss. Normally we would set a stop loss, say, around 1% or maybe greater to close a short put. For the new strategy, what we're going to recommend is closing the offending spread. We would close the put and the call. It would be a spread order, in order to close the spread. And then inside of those contingent orders, we would have orders to close the non-offending spreads. This way, let's say, for example, if the market's going down, we would, at a certain point, we would say close the profitable bear spreads, and then later, if it did hit, then we would close the offending put spreads, and vice versa on the other side. This would be an example of how we might do this. This is an Iron Condor with the 385, 395 put spread and a 500, 510 call spread. And so at 1%, we would set a spread contingent order at 399 to close the put spread. We would set a contingent order at 495, which is 1%, just like we've done for the short put. But in this case, we would set a contingent order to close the bear spread. Then we would also set, say, a contingent order at 404 to close the bear call spread, and then a contingent spread order at 490 to close the bull put spread.
Okay, let's just discuss this. Let's go back one slide there, Mike. Let's just discuss that because that's a lot of numbers, and yeah, this one here, that's a lot of numbers, and that's a lot of things to look at. Now, remember, we're looking at a four-legged spread here where we've got a bear call and a bull put. Now, you still have the standard stop order set at the 1%. And Ben just asked, Ben just asked, please explain what you mean by 1%. 1% of what? Well, we're looking at the 1% of the strike price, the short option strike price on either side, Ben, as a contingent order to close the position. In Mike's Iron Condor book, he shows a example of historically why it's better to use the stop loss of 1%. So in this original spread, when it was set up, we had purchased a 385 put about 1 month out in time, and at the same time we sold a 395 put. That was the bull put credit spread side. And we also opened by selling a 500 strike call and a 510 strike call on the other side. Buying to open, I should say, a 510 strike call on the other side. The short options, the 395 put that we sold and the 500 strike call that we sold, are our obligations. These are the ones that would cause us to do something. We sold that. We obligated ourselves to do an action. By selling the 500 call, we're now obligated to technically deliver shares of stock at that price or index at that price if the stock's trading above it. And with the 395 put, we're obligated to potentially purchase shares of stock or have the cash secured value if the stock's trading below it. So if the stock ended at 390, I would have to go ahead and pay 5 points to cover the obligation at 395 short put. So we don't want to let the index or the stock go below 395 or above 500. What we're going to use is 1% of the strike price, Ben. So in this case, when we sold the 395, the first order that Mike would normally have on the Iron Condor position in the Optium or the Chromium trade folios of power options applied would be to adjust the position if the index fell to 399, which is 1% higher than the 395 strike price. On the same side, the bear call contingent order, or closing or adjusting the bear call side, would be triggered at 495, which is 1% of the 500 strike call. But based on what happened to those positions during May 6th, during the flash crash, what is now known as the flash crash, these adjustments now, what, Mike, you would look to do is if the index had dropped down to 404, 5 points away from your contingent order for the bull put side, you would look to close out the bear call side, which would have a profit from where you originally opened it.
That's right.
So we're not closing the lower side now when the index or stock dropped to 404. We're actually closing the bear call side, which might only be down to 10 or 15 cents cost, and we probably originally received 50 or 60 cents just on that side of the spread alone. So it's sort of a secondary contingent order here to close the bear call side if we hit 404, and then you'll still look to adjust the short put position if it drops down to 399 after that, or, as you mentioned in that previous slide, buy to close the short put and close all of the long, the 385, or close half of the long there, depending on the prices and the adjustment requirements.
Right. Well, now we're just going to advocate, doing contingent spread orders, and that way we don't get bit like we did on May 6th.
That's just extra safety, extra precautions, because as we all know, the market can tend to be rampant chaos, and even experts, even people who have been trading for decades, these kind of events, you just don't know when they're ever going to happen, and they can happen. And this one, even something like this, might happen again. And we hear about all the things that the SEC is doing, new laws that are passing, new adjustments they're making on the electronic boards and all of that, but something could still happen again. We just don't know. So it's really important anytime you're trading any strategy, but even the Iron Condors, they're great strategies, neutral strategies with a good premium, and as we showed, the special margin requirements. But the trick is always have an exit plan in mind with whatever strategy you're doing, and make sure that you know going in what your maximum risk is and that you're not risking too much of your portfolio in any one position.
Hey, Mike, we lost your audio for a minute.
Oh, I'm sorry. I was just, I'm sorry, am I back now?
You are.
Okay, I'm sorry. I was just emphasizing the concepts of when you open a position, whether it's a Condor, credit spread, any position, make sure you're aware of what the total risks are. It's always important to have an exit strategy in place. We never know when this kind of events are going to happen, and just make sure that in any position that you're in, that you're not risking too much of your portfolio value in any one position. Imagine the worst case scenario and make sure that you're still comfortable with that potential loss in your portfolio if the absolute worst case scenario happens.
That's right, and especially with Iron Condors, you want to consider the worst case, because the worst case can happen if if a 9/11 or some major event, negative event happens. The market could open down 100, 200 points, and you go right through your Iron Condor and be in a mess. This change does have some trade-offs, and the positive thing is that now we'll be more likely to exit cleanly, and we won't have to be as concerned about events like the flash crash. And also it doesn't require really any extra effort now. You set the contingent orders, and everything's taken care of. The amount of reserve, before we had recommended people have reserve capital, so they could exit a position, and really that's probably minimal. Probably don't need any now, but maybe just a little, just to be sure. The kind of the drawback is that now there's, on that SPX position we had on May 6th, we ended up having a profit. With this strategy, that wouldn't happen. We would have a loss, and we wouldn't have a way to recover. Another thing is that, a reason to keep a long option open is so that you can hedge other positions in case the market continues to go down or up, to go against you. But now we won't be able to do that. So, but then hopefully we won't have this flash crash problem. All right. We have a number of, I guess, do we have any questions? This would probably be a good time for some questions.
Well, we've had some questions come in, and I've been answering them. We've had a few questions come in. Let's see here. One of the ones that Ben had been asking, I just want to review this. It's not actually related to this scenario, but Ben wanted to know, because you had mentioned Quantium, of course, the double diagonal trade folio that was available at PowerOptions Applied. And right. Ben wanted to know if we're going to be doing any presentations on calendar spreads, calendar call, or calendar put spread, or the double diagonals. And I informed Ben that, yes, we are planning on doing that, maybe in the next month or so. And what we'll start off with is I'll probably host a couple of strategy discussions on doing horizontal and vertical calendar call or calendar put spreads. And then what we'll do is show the difference between those strategies and using the calendar calls and calendar puts onto the double diagonal positions, and then we'll bring you in to discuss more of the double diagonals as you are more familiar with the double diagonal strategy and how to use Quantium and how Quantium works with the double diagonal techniques. So that was a question that Ben asked, and I've been looking forward to a reason to do the calendar spread strategy series with our archived webinars, as we did with the vertical spreads and the protective option strategies. But what we're also going to do in the near future is release release tools on PowerOptions for searching and analyzing the double diagonal spreads. And when we do that, that's probably going to coincide when we do the double diagonal presentations and discuss Quantium as well.
But for those of you that are, considering doing some kind of a calendar spread, the double diagonal is kind of a combination of a calendar call and a calendar put.
But a little bit different.
Yeah, but it's a kind of a way you can learn about calendar spreads without getting hurt.
Without getting hurt, you're exactly right. Most of the time,
without getting hurt too bad. Let's say that. Nothing's perfect.
Yeah, see, a standard, when I talk about a horizontal calendar spread, I'm using the same strikes where I'm selling a call that's right at the money, maybe 1 month out in time, and I'm buying a call option at the same strike that's a couple months out. And when we talk about diagonal spreads, of course, the standard diagonal spread is what some investors use to mimic a covered call trade. I'm going to buy a deep in the money call that's several months out in time and sell a short-term call against it that's slightly out of the money. So I still have a bullish position. But when we do the double diagonal, we actually switch that a little bit, so the long call that we're buying that's further out in time is actually further out of the money compared to the short call that we're selling, as opposed to being in the money. So they're actually, even though it's a double diagonal, is a diagonal spread, it's actually different than what's considered a standard diagonal, which most investors use to mimic a covered call position, but pay less money by buying the long-term call that's in the money instead of buying the stock. But it can be done both ways, and that's what the whole presentation is going to be about. I've got another question that just came in here. Let me just take a look. Here we go. Peter wants to know, he's been quoted a commission rate of $1 per contract at Options Express. Now, taking your OEX Iron Condor position in this month's Meridian Trade folio as an example, you would spend $4 commissions for the 4 legs for each spread, and would receive in the best case a 15-cent net credit if the position expired successfully. This works out to be over 25% of the profit going towards commission. Is that typical?
Well, in Meridian, we are going for lower returns in the 2 and 3% range. So the amount of brokerage fees that you're hit with can be significant, and kind of the way around that is really just to try to trade more capital.
Yeah, and Peter, I would say that in general, if I just look at a one contract approach of an Iron Condor strategy, even an Optimum that's looking for a higher return, if I'm just looking to trade one contract of each, I agree exactly with what Mike said, is that 25%, yeah, that would be about right in most brokerages, depending on the net credit I'm receiving, while still looking for that good probability, still being out of the money on both ranges well enough to have a good probability between. It's highly likely that my commission rates with a 4-legged spread might be 15 to 20 to 25% of the capital. But of the net credit you receive. Thank you, Mike. But absolutely, if you have the funds and you're doing it securely, where you're increasing the number of contracts, increasing the capital that you're invested, that sort of can make the the commission costs more negligible. But you still want to make sure that you're not over-risking everything in the same position.
I tell this to anytime customers call, or most of the time when customers call me on the phone, is always, call your broker and tell them, I'm trading this much, I'm going to be trading this many contracts a month, and a lot of times they'll cut you a special deal. So it's a good thing to call in and see if you can kind of get a reduced brokerage, especially on an Iron Condor before 4 legs. They might cut you a special deal on doing condors.
Okay, let's see. This is a question I believe you discussed in the book, Mike, and I was actually going to point this out as you mentioned it. But earlier on, we were talking about reserve capital to close the positions, and right. Jeffrey wants to know, what is sufficient funds to close out a position, as alluded to in the OEX and XPX examples given earlier? Or in the flash crash, was there really no sufficient margin whatsoever?
There was, but it was like 10x what we would normally recommend.
Okay.
Normally we would recommend 10% of how much was invested over 4 if you had 4 positions. But in this case, you would need 100% pretty much in order to exit even one position.
Yeah, in the past 12 months before this, Jeffrey, before the flash crash, the amount of capital that Mike just mentioned that was, listed in that that he talks about, I should say, in the Iron Condor book, was more than sufficient over the course of the 12 months leading up to the flash crash. But in that severe example, that unruly situation, for lack of a better term, I'm struggling to say, it's kind of thrown out the window. I mean, there was no sufficient margin that we would recommend having that much aside, because you never expect that to happen. And of course, as we all find out as traders and investors, when we never expect it to happen, that's when it typically does.
Yeah, and it's kind of ridiculous, because it really defeats the purpose almost of trying to do special margin Iron Condors. If you're going to have another identical set of capital free just in order to get out of a position, then you really haven't gained anything by trying to do special margin. That's another reason why we've changed this contingent order thing, is because that way you don't have to have a significant amount of reserve capital. You have a minimal amount. You should always keep a little reserve capital in your account.
Okay, here's a question. We haven't reviewed yet the other trade folios. That's the next slide. But Peter wanted to know, how did the other trade folios fare during the flash crash?
Well, they were all negatively impacted, but not like the Iron Condors. The Quantium, we didn't have any real issues like on the Condors. We had some positions we rolled out to next month. That's kind of the problem with the Iron Condor special margin, is that you can't roll to another month, because then you lose your special margin privileges. And then as far as the covered calls and collars, they were negatively impacted, but not like the Iron Condor. We did have a couple of positions for palladium, which we have collars on some of the positions, which the puts were in the money, which I closed this morning.
And if I'm going to send everyone a link here on the chat board, but Peter, if you go to the website, PowerOptionsApplied.com, and click on the Products tab on the left-hand side, you'll be able to see the differences of how these were affected, how the trade folios were affected. And of course, as Mike mentioned, if you look at the ones for chromium and optium and even meridian, you see what happens when you break over the edge there, unfortunately. But you can see the other examples as well of the different portfolios there, the different trade folios, I should say, and how the Quantium fared, how palladium fared, and how titanium fared. And as we mentioned earlier, Mike is also looking at opening up a new service there, a new add-on service to different portfolios for the insurance policy on using put options on the indexes, perhaps, which can coincide with the titanium covered call portfolio for protection if there's a sudden shift, even the Quantium, I guess, if there's a sudden shift, and of course palladium, which may already have protection in place, but it's added insurance onto those.
Yeah, we're going to recommend to customers use maybe half or 1% of the portfolio every month as insurance. And then if the market tanks, then we'll be able to make some profit on that insurance. And
got another
hopefully hedge positions like for titanium. We're going to make that free too. So anybody, even if you just have a portfolio of S&P 500 stocks, you might want to use that to hedge your stock portfolio.
Okay. Jeff asked another question. What happened to the RUT, the Russell trade in chromium? It was never closed, but is it going to expire?
Well, that one is AM settled, so the index is already settled as of this morning. We don't know what the value was, but as far as I know, that position is going to be profitable for the month.
Oh, Jeff did. I stated that wrong. Jeff did type it right. He said, but just expired. He realized that it was an AM one, so that it was going to expire this morning. Okay.
Yeah, we'll get the final settle value for the Russell, this after or later this evening, and then we can see it. But it should have, as far as I can tell, it should finish profitable for the month, which was the only one of the Iron Condors that finished profitable this month. Well, actually, that's not true. The Optium one was profitable for those that had sufficient capital. The only one that finished normally, like most months, profitable, that was the Russell for Chromium.
Okay. Let's see here. All right, I sent everyone the link where they can look at this, but why don't you just briefly discuss the services that you have over at PowerOptions Applied?
Okay, we have Optium, which is Iron Condor, and that one, we enter the positions, for a month out, and we don't roll them or anything. We will set the contingent orders to exit. Starting next month, we're going to put on this new contingent order strategy. We may not be able to support it with BrokerLink right away, so be aware of that for those of you using BrokerLink. But we will support through AutoTrade. Chromium is like Optium, but we take a wider wing, and then we roll the positions. Quantium is a double diagonal, and it's a neutral strategy similar to the Iron Condor. But that one we don't set contingent orders. We just roll out to the next month, or we'll start out maybe in a double diagonal and then roll to an Iron Condor. But we don't get the special margin privileges for that strategy. So that's kind of our returns are kind of half what you would see, with Optium or Chromium. But it is a little safer. As you can see, it didn't get bit by the flash crash like the Iron Condors. And we have the titanium, which is covered call. And that one is kind of primarily why we're adding this new safety net insurance thing. But you can certainly use it with the other strategies as well. And then palladium, we do the covered call collars. We do that on ETFs. If the market's bearish, then we'll do it on the inverse ETFs. And then we have Plus, which is all of the above. And then as we add strategies, have access to it within Plus.
Yeah, Plus just you can have access. You probably don't want to necessarily trade all of the positions that are listed for every trade folio unless you really have the capital and you really are confident or comfortable with what you're doing. But the great thing about Plus is that you have access to all of the ones. So the palladium with the protection, the chromium, the quantium with the double diagonal. You can pick and choose sort of which spreads best match your sentiment on the market and what you're looking to achieve.
Well, we do have some customers that have some fairly large bankroll.
Of course.
And they do trade all of these, so you can do it. And of course, you can order the book. You can order that on our website, $19.95, $3.95 plus shipping handling. We have a special deal. You can get the book plus a half-price newsletter, Optium, for the $69.04 plus the $3.95 shipping. You can get to that at PowerOptions Supplied website and then /condorpromo.asp.
Right, and this is available for customers that currently are not in Optium already. Is that correct?
That's right. That's right. And we do have a free trial. So if you subscribe and you're not, if it's not for you, we'll refund your subscription. And if you want to talk about PowerOptions.
Yeah, I did, and I might actually, I'm just going to send this real quick. I'm going to send that link to the PowerOptionsApplied.com/condorpromo.asp for the book and half price, excuse me, book and half price Optium for new customers to the Optium. Before we discuss this, I have another question from Jeffrey. What I was actually going to do is, we have some extra time here, so I was going to take 5 or 10 minutes and just show a brief discussion on using the search tools on PowerOptions and the alerts that you can set in the portfolio tool on PowerOptions for the Iron Condors, for those that are self-directed.
Sure.
But Jeffrey had a quick question. Why was Chromium Trade Folio hit harder than the riskier Optium portfolio in this particular flash crash?
It just had to do with timing. It just had to do with the way the marbles fell, I guess. It just let's go back to that. every one of chromium's positions were like this OEX, where the stop loss was breached, and then the market immediately rubber banded back.
Mm-hmm.
You can see the difference for the SPX, for the Optium. And that's why it wasn't hit so bad. It's because we had some time. It's just, I guess, serendipity. Negative, as I mentioned earlier, it's negative serendipity. You know, the chromium positions were wider. They had, but it's just the way it happened.
And the timing and the stops and the particular one. So it's just an unfortunate that even though that this was the Optium is a riskier one, and as I mentioned, the link that I sent to everyone with the PowerOptionsApplied.com/products.asp, you get a brief overview of what the goals are for each trade folio and what we're looking to achieve, of course, and the success rate there, but it also shows you the track record as well. So Optium is usually less out of the money, looking for a higher return, a little bit riskier, but in this flash crash, it just so happened that the one that was usually considered more conservative was more conservative, the chromium, just because of that severe, unruly situation. It just turned out as Mike said.
And I think, going forward with the new change in the contingent orders, the chromium, we should see that again. And the chromium will definitely be less riskier than Optium. And in the past, chromium has been less risky. It's just this particular window, it just happened to line, all the stars got lined up and fitted.
Right. Okay. Well, I tell you what, let me manage over here. I don't see any other questions coming in. I'm going to give everyone a quick review, very quick review of the search tool there, and where we suggest they start off using the search tool on PowerOptions if they're self-directed. Remember, PowerOptions applied. You can follow along with Mike, look at the selected trades. He sets the contingent orders for the Optium and the Chromium, the Iron Condors. Self-directed investors can use the PowerOptions tools to identify their own positions and what they want to see, and use the portfolio tool to track and manage those positions. And of course, if you are a self-directed investor and you're using the PowerOptions tools and you're interested in these strategies, if you haven't yet, I highly recommend picking up the Iron Condor book that we've been talking about, because that discusses Mike's approaches, Mike's philosophies, and what he's seen in the market, and what he's been trading over the past 5 years or so. Is that correct? Or 6 years or so in the Iron Condor positions?
5 years. Mm-hmm.
5 years. Okay. Well, very quickly here, let me just navigate over, and I'm going to go ahead and take control of the presentation. There we go. And we're going to go right to the Iron Condor tab menu on PowerOptions. As we discussed in Part 3, and you all can review this in the webinar archives, that would be in the easiest place to access it. We saw the link earlier, but let me just go there now. If I'm in the main Home tab on PowerOptions and I click on Learning Center, from the main Learning Center menu, we can go to Webinars. And in the Webinar section down here at the bottom, over on the right, we have our previously recorded archives, some different option strategies discussion. But in the PowerOptions Applied archive, you can see Part 1 of the Iron Condor presentation, Part 2 of our Iron Condor presentation, and Part 3, which focused on using the PowerOptions tools in the portfolio. But just to review a little bit of what we discussed in Part 3 of our presentation, to identify Iron Condor positions, such as the one that Mike discusses that he looks for in his Iron Condor book that was co-written with Ernie, rather than going directly into the main search screen, we'll want to start off in the Sample Searches tool of the Iron Condor, the Sample Searches section. So I click the Iron Condor tab, then we'll click on Sample Searches. And I have two default searches set here, one for Index and ETF Iron Condors and one for Iron Condors on higher price securities. We want to start off, use the Index and ETF Iron Condor sample search as a stepping stone. And what we've done with this search is we've put in some basic criteria to identify Iron Condor positions that have a reasonable probability between, still have a decent return, a decent range out of the money, but we've told the system to only identify positions on indexes, ETFs, and holders. Now, these might not match your personal risk-reward tolerance, which you look for when you're trading your Iron Condors, but if we simply scroll down below the listed trades, you see we have our time frame set to be at least 45 days out in time. We're forcing the short call and short put to be at least 5% out of the money. If you want it to be more conservative, you could change this criteria, place it to be at least 7% out of the money or more on both sides. Minimum net credit, if you wanted to make an adjustment there, you could do that as well. And also, when we scroll down at the bottom here, you see we have indexes, ETFs, and holders. But once you make those small adjustments, let's just say I try that, force it to be at least 7% out of the money on one side or the other, and then we'll go ahead and click on Submit these settings. It's just going to re-go through the available index ETFs and condors, but now identify only those ones for me that are at least 7% out of the money or both sides. I could also adjust the probability. You see here in my columns in the results table, I have it set up to sort by highest probability, so I'm looking at the higher probability trades that still match my return. So we advise starting off in the sample searches section, pulling up that index, ETF, and condor sample search, and then making your adjustments. And of course, as we went in depth to in Iron Condor number 3 presentation, we set up our portfolio tools to greatly help with your tracking and managing of the Iron Condor positions. I have a few that have expired here, but what I want to look at is this. You see here I have a GS position down here at the bottom. It tracks it as a linked position, so I have 3 Iron Condors here, NDX, SPX, which expired already, and then I have a Goldman Sachs position here as well that we just used as an example. But one of the features that we're going to enhance that we already have a lot of information on when you're tracking any position, whether it be an Iron Condor, credit spread, debit spread, collar spread, or married put position in the portfolio, using this alerts column, if you click on View next to your strategy, you can set various alerts for if the stock price moves up or down a certain range, if there's a change in the option bid price, or if you hit a certain limit of the days to expiration, that's available as well. And what we're going to do is based on what Mike has just discussed here about using the contingent orders, we're going to enhance some of this so you can put in 2 contingent orders on the downside and on the top side, or 2 alerts, I should say, as he mentioned, to be alerted to close maybe the call side if the stock drops down within 2% of your short put strike price, and still be notified if it drops down within 1 or 1.5% of your short put strike price or your short call strike price on the other side. So you can use this to greatly help you with your management positions and alert settings in the Iron Condor portfolios. And again, to get a full review of the tools on PowerOptions for those of you that are self-directed, just remember, go to that webinars link on PowerOptions, and you can then go ahead and discuss the you can go ahead and review the full hour presentation on using the PowerOptions tools for the Iron Condor position. All right? Okay, so let me just go back here, and let me just go all the way, sorry about that, let me go all the way down to the presentation here. And I guess we can, this is our last slide, isn't it, Mike, here?
Yes, it is.
All right. Now, one other thing that's discussed in the book before we wrap up, and please feel free to, if you have any other questions, please feel free to send them over to us. Another thing that we should mention, and one of the big things that was in your book, Mike, was the fact that how successful the Iron Condor strategy is after large, volatile moments in the market.
Right, and that's one of the things we show in the book, is that how the Iron Condor performs very well after events like we just had in the market. Usually for several months after that, the Iron Condors will do very well, especially, as long as the VIX stays up above 20.
Mm-hmm.
The Iron Condor on, for indexes is a good strategy. It's when that VIX starts dropping low, below 20, and gets down around 15, it gets kind of iffy. So
that's right. That's right. Yeah, so this might be a good opportunity in these type of scenarios. Of course, remember what we said. We don't know what the market's going to do. When you're entering these positions, you always want to have an exit strategy in place. You always want to make sure that you're not risking more than you can withstand to lose. And imagine the worst possible case scenario in an Iron Condor position, and if you're not comfortable with that amount that you're risking, then step it back a little bit. Always have the exit strategy in place. Never risk too much on any one position. But going forward, what Mike discusses in the book, I think it's in Chapter 3 or Chapter 4, is what we've seen, what he's seen historically, is that after volatile moments, after extreme events in the market, that's usually when the Iron Condor positions are the most successful. All right, I just want to mention this real quick. Please, if you have any questions at any time regarding the PowerOptions applied services, and you want to talk to Mike and discuss what he's doing with his different positions there, or if you have questions about the PowerOptions tools, of course, or about the Iron Condor book, please feel free to email us at any time to support@powerop.com. You can also give us a call toll-free at 877-992-7971 if you live inside the continental U.S. during market hours. If you live outside the continental U.S., you can just reach us at 302-992-7971. That's the international number. And, of course, there's contact links on every PowerOptions and PowerOptions Applied page. All right. Well, I don't see any other questions coming in from our attendees. We are just about a minute or so past the 1 o'clock hour Eastern Time. I want to thank everyone for joining us for the presentation this afternoon. I hope you got some good information out of it. We did, as I mentioned, archive this presentation. It will be available in that Learning Center section, the archived webinars for PowerOptions Applied, Part 4 of this Iron Condor presentation. Possibly later today, but more likely early next week, Part 4 will be available. As we mentioned earlier in the discussion, when Ben asked his question, I'm not sure what our next strategy discussion is going to be. If we're going to do a Part 5 on the Iron Condors, that's a possibility. But we may be looking to start, I'm probably going to be looking to start strategy discussion on horizontal and diagonal spreads in the near future, maybe in the next month or so. And then we're going to turn from the diagonal spreads and the horizontal discussion into looking at the double diagonals and those strategies based on what Mike's been researching, what he's been doing, and a discussion on the Quantium trade folio, which makes use of the double diagonal strategy. Mike, did you have anything else you wanted to add this afternoon?
Nope.
Okay.
Thanks for joining us.
All right. Now, I just want to remind everyone, if you have the time this afternoon and you're still interested in getting some education, every Friday at 4:30 p.m. Eastern Time, I host a free presentation. It's an open discussion. The open discussion, I don't have any material to present, but you can come in and join me at 4:30 this afternoon Eastern Time. You can sign up for the webinar right on the PowerOptions page there for the open discussion webinar. Just show up, ask as many questions as you want, questions about your positions, general options strategies, options techniques, using the tools on PowerOptions, or if you have questions about PowerOptions Applied. Feel free to stop by today, 4:30 to 5:30 this afternoon, and I'm just there to answer everyone's questions. And we'll let you all know when we're planning our next strategy discussion. This has been Iron Condor Presentation Part 4. This will be archived again, as I mentioned, hopefully early next week. We'll have that available in the archive section. Thank you again, ladies and gentlemen. I hope you have a great expiration day going forward. If all your positions haven't been closed already, that in the next couple of hours you see what happens for all of your positions. Please give us a call or send us an email if you have any questions. And take care. Happy trading. We'll see you all again soon. Bye-bye.